Well, good afternoon, ladies and gentlemen.
Good afternoon, Mwalimu.
Afternoon, mwalimu. Afternoon, mwalimu.
Good afternoon, mwalimu.
So, thank you for the response and welcome to today's session. We're almost coming to the terminal end, but fruitfully. So today is a session where we want to focus on the statement of cash flow in detail, which is an addition to the two other statements we have always done, which is the statement of financial position and the statement of profit or loss. Majorly, the statement of cash flow focuses to be able to show a business or readers who are the users of the financial statements how the cash of a business changes from one period to another by showing the different sources of those cash and cash equivalents. I'll open this with a very simple example. Assume you start the day, which you, of course, you start the day with cash balance in your M-Pesa. Let's assume this is your M-Pesa. You start the day with an M-Pesa balance of 40,000. Then you close the day. By the time you are closing the day, you have Fuliza, $2,400 Fuliza in your M-Pesa statement. So what is your movement in your cash? Only M-Pesa. What is the movement, the net movement in your cash balance of M-Pesa? So generally, here, it shows that you started with a balance of 40,000. You went all the way from a balance of 40,000 positive, all the way to zero. So already that is 40,000 movement. Then again, you went to the negative 2,400. Again, 2,400. So in total, the cash movement from here all the way to here is actually a decrease. Over the period, there was a decrease in cash of 42,400. So remember, it could be that you actually had receipts and payments. So now what is we are supposed to see the cash flow statement. The cash flow statement will be able to show us a movement or a detailed breakdown. A detailed breakdown on how the movement occurred by showing what came in and what went out. The inflows, which we call the cash receipts, and the outflows. However, we don't just show them the way we do a cash budget, because now when we come to the costing aspect, which we shall look at, I think, in our last class from the cost outline, when you look at the concept of the cash budget, it's different because you only show that cash inflows versus cash outflows. But here now, the inflows and outflows are still categorized into their different classifications. Still, the inflows and outflows will be shown under their different categories. And these categories majorly are three. We usually say we have cash movement brought about from operating activities of the business. This one will concentrate on the major. This concentrates on the major trading activities of the entity. For example, when we are looking at a law firm, their major trading activity is probably to offer legal services, then pay for the normal operations of the business, like rent, salaries, and that. So any cash movement within those sources of legal fees, payment to employees, payment to office rent, payment to stationaries that are used to ensure the smooth running and achievement of the trading activities of the business, then will be recognized under operating activities. Then we'll be able to show cash movement from investing activities. Now, these investing activities are the cash to acquire long-term investments or assets of the business, like purchase of non-current assets, purchase of building, or selling those non-current assets, or the income generated from them. If the business decides to invest in shares now, the income generated from there is an investment business, is income from investments, because that is not the normal operating or trading activities of the business. Then we will have cash flow movement from financing activities. This one will look at the long-term sources of finance. Looks at the long-term sources of finance. Finance of a business. Majorly, here we look at long-term bank loans, new loans or repayment, long-term bank loans, new loans or repayments, cash from issue of shares, when a company gives out shares so that it raises finance, that is a financing activity. Dividends paid, or drawings from the business. But you are going to realize, however, interest appears under operating activities because we assume we pay it as an expense of the normal running activities of the business, which will appear under operating activities. So generally, that is the categories under statement of cash flow, which gives us a breakdown for us to be able to gauge if this period, the cash of a business has increased by 10 billion, we don't want to assume that this business is very liquid. They're able to generate 10 million. The entire 10 million could have actually come from only financing activities, which will indicate to us then that this business is actually not generating cash from its operating activities. That is why it is important to be able to show the classifications so that we can make sense of which area of the business is actually giving liquidity to the business in general. Now, having done that, and given the introduction of what we are going to do, then probably you are going to realize that we have two methods of preparing a cash flow statement, where we have what we call the direct approach or the direct method. This method, a business will need to have all records of its cash inflows and outflows, because then here you actually need to know, I paid this to suppliers, I paid this to wages, I paid this to particular expenses, I received this from sales and all that. So for the direct approach, the business will usually pick its cash inflows and outflows from the cash book by looking at the payments and receipts. By looking at the payments and receipts, and then classifying them to their different headings. So here, it's actually an easier method, because you don't need to struggle, you just need to pick from what we have done. However, we have the indirect method or approach, the indirect method or the indirect approach. In this method, the company or business works backwards from the statement of profit or loss and adjusts for non-cash items. Now, remember, there is that concept of the accrual basis. You know, it tries to eliminate accrual basis items that were recognized. Remember, the accrual basis of accounting, which we look in chapter 1, usually details to us that whenever we are preparing our financial statements, majorly the statement of profit or loss and the statement of financial position, we recognize income and expenses when they have occurred, not necessarily when the cash has been received. So because of that, you then get to realize that in the statement of profit or loss, there will be so many items, incomes and expenses, that have been recognized based on a method where we are taking the items before the cash has been received, or cash has been received and we have not recognized it as an expense. So the cash and the profit will not be showing the same amount. So we want to work from one to arrive at the other. From the statement of profit or loss and adjust for non-cash items to arrive at the cash balance. To arrive at the cash balance from the profit for the period. From the profit for the period. And here you see, even in the statement of profit or loss, there are non-cash items like depreciation, which naturally, depreciation is not a cash item, it's an imaginary cost. Profit or loss on sale of non-current assets. Those are imaginary items because our main idea is the cash. However, this is majorly in the operating. However, the two methods only differ in the statement, in the cash flow or movement. In the operating activities section. That is what you are going to realize in the operating activities section. Because the other ones, the method will remain the same, although some figures, of course, even in the direct method, you may need to actually work them using backward concepts. So majorly, that is, an introduction to the statement of cash flow. Any question if I move on? Okay, now, when we talk about cash of a business, then there are several things that constitutes cash. So the question is, what is cash of a business? What is cash of a business? Usually cash of a business, we look at cash and cash equivalents. We take into account cash and cash equivalents. Whenever we talk about cash of a business, cash and cash equivalents in the short term, things that a business can actually say they have cash in the short term. So the first aspect is cash at hand. Any cash at bank, so add cash at hand, add cash at bank, add any cash in money markets or short-term investments like money market. No. Then, if the bank is an overdraft, then we say less bank overdraft, because it means it's a negative to give us. So this is going to be less. So this figure can be a positive or a negative. Then it will give us at a particular point in time. Cash and cash equivalents at a particular point in time, which can be a positive or a negative, which can be a positive or negative. Cash and cash equivalents at a particular point in time, which can be a positive or a negative. Generally, that is what constitutes cash and cash equivalents. So when you take the cash and cash equivalents at the start, assuming the start I got 40,000 and the end I've gotten negative. This is now negative, let's say 24,000. So it means my cash and cash equivalent has moved. So there is a decrease. So the movement is either a decrease or an increase in cash and cash equivalents. Good. Now, let's look at cash flow from cash and direct method approach. Before I go maybe there, we could look at, from there, what is the importance, by the way, of looking at or preparing a cash flow statement? Especially, why do you think of these two methods, direct and indirect, which one is advocated for as a best practice? You realize that the indirect method is taken as a best practice, and companies in accounting are not allowed to use the direct approach. When we are preparing, especially for companies or accounts for publication, we are not allowed to use the direct approach. It's actually that we are supposed to be using the indirect method or approach. Generally, why? The reason is, you see, when you are able to link your profit back to your cash items by showing us, I had this profit, when I adjust backwards for those non-cash items, I arrive at my cash, which is physically here with me. Then it tries to give us confidence that your books of accounts have not been manufactured or cooked, in quotes. When we say manufacturing books or cooking books in accounting, that they are not fraudulent showings, that you have not actually involved yourselves in trying to do monkey businesses around the preparation of your financial statements. Although it's not still a guarantee, but at least whenever you do monkey businesses, then it starts becoming difficult to link your statement of cash flows back to your statement of profit or loss. Yes, Njiraini, sorry, your hand was up, I'm not seeing it. Go ahead.
I want to apply the idea that you had just started with, the 40,000 and the 24,000. 24,000.
2400.
2400, sorry. 40,000 and 2400. Now,
negative.
Yes, it's a negative. But when we started, you said it's a Fuliza amount. So in my possession, I have 40,000 and I have 24,000. So I have 42,400, right?
No.
Now when I'm
You got it wrong. No.
I got it wrong.
First, yes, because what we are saying, I said you start the day. You have woken up today morning. You had 40,000 in your M-Pesa balance, correct?
Correct.
By the time you close the day, you are going to sleep, you realize your M-Pesa balance is now a Fuliza. Fuliza is a negative. We said Fuliza is a negative. When I indicated Fuliza, it means now you are the one who owes Safaricom. You get that? It is a negative amount in
my books.
In your books. So that's why I said if we started with 40,000, we came all the way to zero. Then we even left zero and went all the way to negative 2,400. Okay. Correct?
Yes.
So it means we have spent over the day, our net movement is that we have moved from positive 40,000 all the way to negative 24,000. So our cash movement is that we have been able to decrease our cash from 40 to 20 to negative 2,400, which is a total movement of how much? 42,400.
22,400. So 22,400 is the decrease. It's not the actual amount that I have in the end of the day. It's just the actual amount of money movement during that day.
Yes, which can either be an increase or a decrease.
So in our case, is it it's a decrease because it's moved.
It is a decrease.
Okay.
Yes.
Okay.
It's like taking, it's simply negative 2,400, the closing, correct?
Yes.
Minus 40,000. The closing figure minus the starting figure.
Yes.
Which says, then you find the movement is a negative. No,
yes,
was 40,000. A
When
negative. So if the movement is a negative, then it's a decrease.
So in the event someone had given in the event you're done some business during the day and the monies are not a loan, they are just payments from the business that you did, it will have gone to the positive side of this equation. So it will have been an increase of 40,000 plus whatever amount you have gotten.
Yes, but remember, even this decrease it could mean so many things. That is now why we are saying the statement of cash flow is the one to tell us how that money moved. You get that? Because
Yes.
it could be you started with 40,000, correct?
Yes.
At some point you received even 30,000 into your account. It went all the way to 70,000. You get that?
Yes.
Then again you paid 50,000.
Yes.
Then again you received maybe 5,000.
Yes.
So there are several movements, but us, we are the first thing we are looking at, we are seeing. You see, when maybe let me use this. When a company gives us their financial statements, they'll usually give us an when the company gives us their, I want to project this. So a company will give us a statement showing, for example, let me take this, correct? Showing that the cash balance, you see here, 2017, they had a cash balance of how much? Here.
Where are we?
Here.
The 16. The
3,000.
Yeah, 3,000. Yes, yes, yes. You've zoomed.
Bank balance and cash in hand, correct?
Yes, 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 yes. 3,000.
So they started with a balance of 3,000. So which is 3 million raised.
Yeah, yeah.
Then 2018, they are telling us they don't have any positive balance. In fact, you go back, you realize they don't have any balance there. Instead, they have a bank overdraft of how much? 4 million.
4 million.
So if last year they had 3 million in their cash, in their bank, now they have actually spent, they are even now on a negative in the bank.
Yes,
so over the period of 1 year, the cash has moved from 3 million positive all the way to 4 million negative. So what is the cash movement in the year?
It's a negative. It's a decrease.
Of how much?
Of 7 million.
Of 7 million.
Yes.
Good. Now that is where the statement of cash flow now will go into detail to tell us. Now let's break it down how this 7 million decreased over the period by showing the movements.
Okay. Thank you.
The 7 million Mwalimu is net, isn't it? So we want to find out what contributed to it, isn't it?
Exactly.
Okay.
And we show we have said we show in how many categories. Some contributions could be from the normal trading of the business, which we call operating activities. Some could be from investing activities like purchase of assets. It could be that you purchased a building with the entire 7 million. You get that? Which shows that you did not trade probably. Or it could be from another source, like you actually paid off a loan, which we now we be shown under financing activities. So essentially, that is what we are doing when we are doing the statement of cash flow. We are reconciling to see how the cash movements in the year happened by giving detailed explanation in form of figures.
That is well noted, Mwalimu. Thank you.
Good. So now, in fact, let me just share that. Because I'd share those notes. No, I want to share this before I go to share this. Okay. Yeah, so that is what I was explaining. So we were here in the importance of preparing. Yes? Oh, your hand is up. Sorry, why am I not seeing hands today? Yes, go ahead.
Just a quick one on that point.
Yes.
Does this mean that that amount will always be provided for in a statement of financial position?
Yes, but I have said
not any other financial statement.
The cash balance.
Yes.
Now, let's come. from our accounting concepts, cash is what under Alice? Cash or bank, those are what under Alice?
Assets.
Where are assets shown? We have two statements. Statement other than the cash flow we are looking today and the statement of changes in equity. The two statements. Statement of profit or loss, statement of
financial position.
Financial position.
What does the statement of profit or loss summarize? Which elements does it summarize?
It summarizes income and expenses.
Income and expenses. Then the statement of financial position.
Assets and liabilities.
Assets, liabilities, and capital or equity. So automatically there now, Brian, that means we cannot be able to get the cash in the statement of profit or loss. We can never, because it's an asset, or if it becomes a bank overdraft, it becomes a liability now. We owe the bank. So we can, or unless you are given a cash book in itself. You get that? If the examiner doesn't give you the statement, then he will give you a cash book showing you the opening cash balance and the closing cash balance. But any other statement? No. Statement of financial position.
Okay. Very well noted. Thank you, Mwalimu.
Now, when we look at this concept of cash flow, I've already explained, the concept of cash flow from operating activities, what it is, investing activities and financing. But in detail here, if you can check, when we are looking at the direct approach, major the direct approach, it is the sources, cash receipts from sale of goods and rendering of services. Why you exist is to do that. Cash receipts from royalties, fees, commissions, and other revenues for those businesses involved in those type of businesses. Cash payment to suppliers for goods and services, cash payment to and on behalf of employees, cash payment to other expenses. Those are the concept of operating. But I've said investment, as I said earlier, is the concept of non-current assets, investments in them, or selling them, or the interests or incomes received from those investments. Then for financing activities, issue of new shares, long-term loans, cash period of drawings, or dividends, in short. But generally, when you look at, of course, the importance, liquidity, we need to measure the liquidity of the business and all that. That is not what my main aim is there. These I've shown this. I wanted to now show the statement. Instead of writing it, let's now assume you have been given the direct method. I'll start with the direct method. So the cash flow from the direct method, you're going to see it differs from the indirect, but it's not the one that is recommended naturally, because this one, you are then going to be given everything by the examiner when you are using the direct method. Then probably the examiner is going to give you everything, because most of the figures you'll actually be able to pull them from the books, especially under this section of operating activities. You cannot just pick them directly. So when you are looking at cash from operating activities here, we are looking at first, so this is what you want to be careful on, the classification, because even if the examiner gives you the cash book, if you will not get the classification right, probably it could be a problem for you to be able to correctly classify that. So when we are looking at operating activities, we have said, you look at the concept of cash from credit sales, cash from cash sales, cash paid to suppliers, cash and credit. You can divide, even up here, you can combine or divide. So it should be able to show in 2 lines or 1 line. That's what I mean by divide them into their different categories, cash and credit. Cash paid to wages, cash paid to other expenses like rent, operating, all that. Then you'll get what we call cash from operations, less any interest paid, if there is any, And if you are not given, this is how we do it, and less tax paid. Then you get net cash from operating activities. So you see, one thing that you realize in accounting, sometimes the easiest, and I've always taught you this, that in accounting, even when we are preparing the statement of financial position, a statement of profit or loss, just knowing the format alone can actually be able to save you, because there are some figures you'll get that they are given directly, and knowing where that figure appears under what heading, then you can easily be able to get. You see, like when preparing the statement of profit or loss, sometimes you are given expenses directly on the trial balance. If you pick them and just take them to the statement of profit or loss and expenses, then automatically you score some marks. But if you get that you have now taken your expense and you have taken it to the statement of financial position, already it becomes problematic. Now, with this, then you come to cash from investing activities, where you get cash received from sale of non-current assets, cash paid to purchase non-current assets, cash from investment income, then cash flow from financing activities, cash received from issue of shares, cash received or paid from long-term borrowings or non-current liabilities, dividends paid, and all that. Then this will be the movement, which I'm going to show you how we do that. So generally, let's consider this illustration with an example. The direct method is usually not very problematic, as you are going to see it. Just let's consider this with an example. I want to take this example. Good.
Mwalimu, if I may, before maybe you move away from the document, which you have
Hey,
already moved.
yes, just continue. No worry.
Yes, I have seen when you're calculating the interest paid and the tax paid in the direct method, you've actually said that is the interest for the previous year or tax for the previous year. You add I don't know, I can't see the document because my question is on the document.
Now, allow me address that because generally in the cash, so allow me address that within the question, okay? Especially when I'm looking at the second question, will you?
That is very well, very well.
Yeah, because mostly all those, and that's why I say the cash flow in the direct method, you are going to see most could be given, others, because once we cover them in either method, they remain the same. So don't worry. I'll tell me if you are seeing my screen now. So I'm sure it's this, you're asking this formula here, correct? Interest paid and tax paid. So I'm going to illustrate that probably using another question. But here you have been told, let's consider here, the following summarized cash account. You are able to see my screen?
Yes, Mwalimu.
Yes, we can.
Excel.
Yes, Mwalimu, we can see.
Yes.
Oh, good. So the following summarized cash account and fixed asset schedule belong to Lactex Limited for the year ended 31st December 2021. So the summarized cash account. So here now the examiner has not given you statements, So what maybe what again I refer back to what Brian asked. I said if you are not given the statement, then the examiner is giving you the cash account probably and a few concepts. So you can pick the cash. So we started with the cash balance wrote down in the account of 500. At the end of the year, we have closed with a balance of how much? 4,700. So that is a cash movement of how much? From 500 to 4,700.
Increase. 4,200.
4,200. And now, that is what I'm saying. You see here already, you can see where the money came from. You have the sources and you have the payments. So meaning, in the direct approach, even the tax paid, you see, in Ashon, even the tax are paid. If it was not given, that's when we could have. But now it is already dividend. So generally here, in the direct method, you are going to see, depending on the information given, usually most of the items you can pick them directly. So let's start. Let's assume we are preparing our statement of cash flow from the direct method for this company, which you are asked down here. A statement of cash flow using the direct method, including a reconciliation of profit for the year with cash from operations. Now, this was, you do a cash flow using the direct method, then later, this way, later within the question after you have done, do a reconciliation, and you are going to say reconciliation. Now, the examiner was asking a small part of the indirect method, which we call a reconciliation between the profit and the cash from operating activities. Okay. So let's start here. Cash from operating activities, cash from sales. So this is the indirect method in that question. Cash from sales. Because we have the cash book of what was received in the period. We have cash sales, we have credit sales. So we can say cash sales and credit, or so cash sales how much?
3,500.
3,500. Cash from credit sales is going to be 5,750. In that question, we have cash from issue of shares. Any cash we receive from issue of shares will go to which section? Operating, financing, or investing?
Financing.
So this one will go to financing. Cash from sale of building.
Investing.
Investment.
Sale of a building.
Investment.
Yes, that is investment activities, because if you check here, cash received from sale of non-current assets or cash paid to purchase non-current assets. Good. Then when we go to now, already we have finished this side, we check wages, cash paid to suppliers. These will go where?
Right.
Ops.
Operating activity. Now,
Yes.
any payment will be shown as a negative. Cash paid to wages and cash paid
To suppliers.
So cash paid to wages is 1350, suppliers 4320. $43.20. We check if there is before. Remember, we need to have cash from credit sales, cash sales, suppliers, wages, other expenses. We check if there is other expenses to get cash from operations. before we go to interest paid and tax paid. So cash from operations. Let's check if there are any other expenses. We can see that we have other expenses of how much? 600.
600.
$600. So what we get here is what we call cash, not net cash, but cash from operations. So cash from operations is that 2980. Then after you've got cash from operations, you see the indirect method is you have the figures almost. You less interest paid.
Excuse me, Mwalimu.
Yes.
Shouldn't this be direct method?
Yeah, sorry, direct method. I don't know why I wrote indirect. Direct methods. Yeah, this is the direct method. I say this is the direct method. Sorry for that. Yeah, sure. This is the direct method we are doing. Less interest paid and less taxation paid. Now, in interest paid, of course, you are supposed to be seeing it on the cash book because you are given the cash book. Remember, because we were given the cash book, that is why we don't have any trouble. So there is a tax paid somewhere of 100, but then there is cash paid on finance lease. Now, remember, leasing is like a long-term liability in accounting. Finance lease is a long-term liability where you pay interest on it. So it could be the finance lease, you're either paying interest or repaying the principal. So you can check if there is any note on that. And there was a note on, was it there? All the 700,000, this one, point number 6, all the Kenya shillings, 700,000 paid on the finance lease in the year 2021 represented capital. This was the first year of the lease and the interest was not paid until the second payment, which was made in the year 2022. Interest of 43 was included in the year 43,000 was included in the year 2021 financial statements. Now, remember, you have been told all the 700,000 paid was for representing capital. Which section will that amount go on then? Leasing is like a long-term liability.
If
It's
it's
also
capital,
financing. So
if
it's
capital,
repayment of capital. So it's like we are repaying the loan. First part of the loan before we even repay the interest here. Cash from financing activity. Cash received or paid for long-term borrowings on and current liabilities. So the guy is trying to tell you, don't take that amount to the interest paid. However, later you are going to see now, this is what I was saying. Sometimes you may be given the interest in the statement of profit or loss. But this was not paid. It was just an interest represented due to the accruals concept, which probably when we will be doing the indirect method somewhere, if we are not been told, and then you are going to see, we are going to actually be able to include it when we are doing the direct method as an uncashed item under the accruals method. Because if it was included in the financial statements but not paid, then it was an uncashed expense. That expense that is recognized but not yet paid, which will come when we are looking at the direct method. So that means there was no interest paid in the period you've been told, so 0. Then there is the taxation now paid in the cash book, then is actually given as 100,000, so negative 100,000. That. Then now we get what we call the net cash from operating activities. net cash from operating activities. So this was cash from operating activities. And that's the net we get. And then we had cash from investing activities. So cash from investing activities, we start with the inflow. Did we have any in the cash book, any cash received from sale of non-current assets, which was the cash from sale of building? $970. We don't have any cash, you know, if we cash paid to acquire non-current assets. Then nothing else, even the cash paid or cash income. Cash from income from investments. Because my English there is wrong. Let's not worry about it. So we are going to have net cash from investing activities, having something like that. Because that is what, or did we acquire? By the way, I'm not checking on the payment. Did we acquire? Cash paid to suppliers, cash, other expenses, fine. No, okay.
We ain't given anything in the additional notes.
Now, because this is the, even if we are given, that will be for the indirect method, probably. Because now, for the direct method, once we get that there is no payment, and then it will be an uncash item. You get that? As long as it does not appear. You see, the reason I went to the finance list is because I just wanted to know, was the finance list payment either an interest or just a principal? Because even though they are non-current assets, fixed asset schedule, what it will only help us is in the indirect method. In the direct method, remember, then everything that was appearing in the direct method must have appeared in the cash book directly. Because in the direct method, you pick things direct from the cash book. Okay?
That's fair.
Yeah. So when we come to the indirect method, probably that is when you'll see a lot of calculations here and there. Then cash flow from financing activities. So when we are looking at cash flow from financing activities, and then we are looking at first any cash received from issue of shares. Remember, anything that is coming in is an addition. So do we have any cash from issue of shares?
Yes, we do.
How much?
1,200.
Cash received from long-term loans or cash paid to long-term loans. You can either have both in a question or just one. From there, we are going to see. So here, did we receive any cash from long-term loans?
No.
Cash sales, credit, no. But did we repay any long-term loans?
Yes, the lease.
The finance lease of 700. So in the direct method, it's actually the cash book you are showing as a statement. Okay.
Minus 700.
Net cash from financing activities. That then we now get what we call net movement in cash and cash equivalents. Net movement in cash and cash equivalents, which is either a positive or a negative. You add the three figures now. The one from operating, the one from investing, and the one from operating. Oh, before that, I've forgotten something. Can tell me what I've forgotten. Under investing activities, there's something I've forgotten.
Dividends?
Yes, dividends paid. Dividends paid.
Mwalimu, is
Yes.
that under financing or investing?
Dividends paid, remember, is under financing, not received. If it was dividends received, okay, it could have been. It means you invested in companies, they paid you dividends. But dividends paid, what does it mean? You have
You've
shares,
paid to shareholders. Yeah.
You are.
You have paid the company or the shareholders.
Yes.
So money is moving from your account to the company.
Perfect. From your account to the shareholders. Long term. And this was how much? 700. Then we have dividends paid. And remember, in the cash statement, does not matter the year. Remember the cash flow as we want to see the movement. You see, you are told final dividend paid 2020, interim dividend. So 100 plus 50, how much do we pay to dividends in the year? It does not matter. You get that? Because the cash flow does not matter the period. As long as that thing was paid in the current year, it should appear in the cash flow statement.
Minus 150.
Minus 150.
Excuse me, Mwalimu. So you're saying if it was dividend received, it will be in the investing activity?
Yes. Okay. Because what does it mean when you invest, when you receive dividends? What does it mean? Where are you receiving them from?
From your investments.
From your investments. Make sense?
Yes, Mwalim, that's fine.
You just, if you have the cash book, you do a last counter check if there's anything you've left out. Cash from sale of building, cash from sales, issue of shares.
We have everything.
We have everything. We are sure. Movement in cash and cash equivalents.
Correct.
4,200. Correct? So you see, then you add opening cash balance in the period to give you. So the opening cash balance in the period was how much?
500.
500. So once we add it there, it should give us the closing cash balance. And that will be now showing. You see, it is just the cash book we have arranged in a statement. You've seen that? Because almost all these figures are already in the cash book. But showing, so it shows that yes, in our period, there was a cash movement of around 4,200, of which 350 came from financing activities, 970 came from investing activities, and the majority of it came from operating activities, 2,880. Perfect. Fine. Now, let me check. You know, I don't know today, the way my screen is showing, I don't usually see when someone's hand is up. So if sometimes your hand is up and I'm not seeing it, I'm not intentionally ignoring it. Okay, you could interject politely.
Mwalimu, just very quickly.
Yes,
If,
yes, Majid.
The change in debtors and change in creditors, if it was if there was any change, it would have shown in the cash book, isn't it? So it doesn't.
You see,
we don't need to look at it.
It shows now. That is where I'm going to go. You see now that change in traders and creditors. Now it's going to help us. You see this where we are seeing the indirect method, a reconciliation of the profit for the year from operations using the indirect method. So that's now where I want to go next, showing, remember, we usually recognize our, you see, like let's assume in the cash book, we have cash from sales of 3,500, correct? And cash from credit sales of 5,750. So in total, how much cash did you receive from sales in that period? 3,500 plus 5,750 should give you how much?
9,250.
But is that the sales figure in the income statement for that company? Probably no. Reason, the company could have sold more, they have not received cash. You get that? It could be that the credit sales are even more.
Yeah. Also, the credit sales could be from a previous year, but you're receiving the money now.
Exactly. So now that is why we want to go to the direct method is the one now that works backwards and tries to assume you don't have even your cash book. Just use the financial statements you have and work backwards to show. So now whatever I'm going to, like the question you have asked, we are going to show and I will explain why, correct? It tries to show that cash movements, debtors and all that, assuming that the other one has been adjusted for.
Okay.
Good, so allow me bring this then as I explain in the
Mwalimu.
Yes. Go ahead,
yes,
sorry.
this Penina, before you move, there's a part I think I missed. I need your guidance. Like in the cash book, there is somewhere they said interim dividend at 50. Kindly go to the cash book or to the cash account.
Okay. So final dividend 2020 100, interim dividend 2021 50.
Yes, so I'm not understanding where we are getting that 150.
So
because as per what
oh sorry, I'd cut you short.
Kindly
Finish.
proceed, Mwalimu.
Oh, okay.
No. Kindly proceed. Yes.
So we have a final dividend of 100 and an interim dividend of 50. So we have paid a final dividend from 2020 of 100. Usually companies declare their dividend at the end of the year, correct? And then they pay it in the coming year.
Yes.
So this 2021. But in total, we have paid dividends from our cash account this year. How much? There's a dividend
Total
of 100
plus the previous.
from 2020 of 100 and the interim day paid for the year 50. So these two, 150, form a total dividend paid from our cash book of how much?
150 from the previous year and from now the current year.
Yes, and I said when we are
I've
looking at the cash book, ignore the years. Okay?
Oh, okay.
When we are looking at the
Yes.
direct method, ignore the years. The direct method. See, that's why I say the direct method is just a summary. Even the credit sales, you see the credit sales like, Nani said, I'm forgetting the name, Majid. It could be even the cash we are getting from credit sales of 5750. No, it could be that we are even collecting this from a customer who had even taken goods from us even 2 years ago. Because when you say cash
Yes.
from credit sales.
Oh, yes, yes. Yes, that is well understood, Mwalimu.
Yeah.
Okay. Thank you.
Mwalimu, by credit sales, you mean tuliuza kwa deni. Now they are paying us back.
Yes.
Okay.
Now, I want you to note the difference between the direct method and the indirect. So I'm going to start down here. This is the indirect and direct. Cash from investment activities, cash from financing activities. Under this indirect method and direct method will remain the same, but I'm going to explain how probably you could calculate when you are not given figures. Because it's the same even in the direct method, cash from investment activities and cash from financing activities. But I'm going to explain how we get these figures generally. But now the major difference is actually here. Cash from operating activities, things like cash from credit sales, cash paid to suppliers, wages, and expenses. You know, this entire section here under the operating activities is going to change when we come to the indirect method. Because now what it does, it actually starts with the, it starts with the profit after tax for the year, which we need to do and work backwards. And that is the reason it is called indirect, that you don't have the figures, you have to work indirectly backwards. And probably I'll start, when this direct method is going to take us into a lot of in-depth accounting, but on very small aspects. But let's start this way. When, for example, when I say profit after tax for the year, usually provided or work backwards from retained earnings. So yeah, I just, jog your mind so that you understand. First, what are the retained earnings of a business? So from our last class, I remember training, what are the retained earnings or retained profits? What are the retained earnings of a business? Yes?
I believe it's the net profit that has not been paid to dividends, whatever is remaining after all expenses.
Is that not, okay. Yeah, I understand. So retained earnings for the year. So let's assume in total, retained earnings of a business then constitutes, can we say all the profits of a business that have been accumulated over time, correct?
Okay.
All profits of a business accumulated over time, not paid out as dividends. Correct?
Correct.
So assume this is the year 2023. I tell you my retained earnings here, 2023, assume I had something like retained earnings of something like 40,000. So I am starting now 2024. See this, so this is the close of 2023. I've closed 2023 having total retained earnings of 40,000. Okay. So in the year 2024 now, I make a profit. In the year 2024 alone, I make a profit of 12,000. So how much should be my profit now before I even close the year? I've made a profit of 12,000.
If that's net, then it's 52.
So my profit, my retained earnings should increase to 52.
Mm-hmm.
To 52,000. But I decide to pay back my shareholders. But before I close the year, I pay dividends of decide to pay them dividends of even 9,000. So I pay 9,000. So how much will I remain with at the end of 2024?
43,000.
43,000. So it will be 40 plus 12 to give me 52, then 52 minus 9 to give me how much?
43.
43,000. So how have I found my closing retained earnings? So I've said my closing retained earnings within 2024. So my closing retained earnings are going to be opening retained earnings. I add what?
Profit.
Earnings, retained earnings for the year.
Profits for the year. Profits for the year. Then less any dividend paid in that year. Dividend for the year. So my question now comes, if I give you opening retained earnings, I give you closing retained earnings, and I give you dividend paid for the year, can you find the profit for the year? As the missing figure
Yes,
from
Mwalimu.
that equation? Yes.
Yes, we can find the profit.
For the
But
year.
can it also be a loss, eh?
Yes, it could be a loss. It could be you
Okay.
made a loss and still you paid dividends. Yeah, it could be a loss. So that is what I'm saying here. That's usually provided. This figure is usually provided, profit for the year. But if not, you need to work backwards from retained earnings. And let's check, for example, here. So in the indirect method, we check here. We have been given that. Then you are given the tax charge for the year, 400,000. The opening balance on the tax liability account was 100. We'll come there later. Proposed final dividend, all that. Then we had, so you see already there is what we call the proposed final dividend for the year that we are going to pay is how much? 120.
20,000.
So already we almost have dividend for the year. Let's check. You are told revenue reserves. So maybe this is what could have confused, but revenue reserves, those who understand, revenue reserves of Latex Limited, that is what we call actual retained earnings. Generally, it's revenue reserves for Latex Limited as at 1st December 2020 was how much? 948. Revenue reserves for Latex at 1st December 2021 was how much?
680.
1680.
160.
So the concept now start asking yourself, we have closed with total reserves of 1680. We opened with reserves of 948. Then in the year, we are saying we are paying dividends of how much?
120.
120. What do you think is going to be the profit for the year? We're doing that 1 minute.
Let me omit it.
He excused himself. Please wait a minute.
Let prepare 1 minute.
Oh, yes, I've given you a minute to take a glass of water. So, you've got that. So let's come down here. So we are saying in 2020, we have our closing retained earnings, which is how much? 1680. This should be equal to opening retained earnings, which was how much? 948. 948. Then plus profit for the year, which we do not know, okay. Then minus dividends proposed for the year, final of how much?
120.
120. Should give us 1680. What was K? The profit. What was K?
1680 minus 948 plus 120.
Minus 948 plus 120. So gives you
852.
852. So you see now, because we had not been given that profit directly, but the examiner had given the, some missing figures. It wanted you to work backwards and correlate that the profit for the period was 852. So profit after tax for the year, when we are using the indirect method, you see it's going to be, the first part where we are being told to reconcile, there we can say we start already profit after tax. Profit after tax is going to be something like 852. Are we together? See, I'm just jogging that in the indirect method, most of the figures you are going to be working backwards. That's why we call it the indirect method. Add back tax expense. Remember, the tax expense is not necessary. Hope by now you understand the expense and what you pay could be totally two different things. Your rent expense could be 1 million, but what you have paid is only 400. But what we are adding back is not what you have paid. It's the tax expense because of the accrual, okay, information given, or use the additional information given to compute. Are we together?
Yes.
There is a hand. Oh. Good. So, add back tax expense. So let's try to check how could we get our tax expense here. So you have been told tax expense, but we had what we had in the summarized account was the tax paid. So it cannot help us unless, let's come here. Addition number 1. The tax charge for the year was 400,000. The opening balance on the tax liability account was 100,000, which was later paid in the year. The 100, that is why probably it was the one that was paid in the year, 100,000. Okay? So what will be the tax expense in the statement of profit or loss? Going to be for the year. Now, this is how you look at it. Usually when we close our years, all the tax expense account is supposed to be actually, if you are not given the closing, but here the account will not help what I wanted to show you. I'll use a different question to show you how the tax realigns. But here the concept is the tax you are supposed to be paying in the current year is 400,000 alone. But then we realized there was an underestimate from our previous year. You know, a tax liability, it means there was an underestimate from our previous year, which we never paid our tax authorities. And that is what usually happens. Many businesses will usually estimate the tax they are supposed to pay. And that is where KRA will usually say, do your own self-assessment. So companies will do their own self-assessment. Then KRA, so if you do your own self-assessment before you close your books last year, you realize that you have actually done a self-assessment, which is lower by 100,000. So you are supposed to actually recognize. You're supposed to recognize you're supposed to recognize. I want to check that how it is shown there. You're supposed to recognize the liability of 100 as an expense in the current period, so that then you pay it off. So in total, the tax expense for the period that will be shown in the P&L is 400 plus 100. So 400 plus 100 will give you how much? If there was no this opening balance, then we could have just taken 400. But we have been told opening, we had a tax liability, which we should now include and recognize it as an expense we are paying off in the period.
500.
500.
500.
Add back. Why am I adding back my tax expense of 500, which was 400 plus the 100? I want to find my profit before taxation. Reason, I'm going to deduct tax paid down there. So that is why I must get my profit before tax as an non-cash item that is being accounted for. Then I'll come and less now the tax paid. Because in the statement of cash flow, what I'm interested in is the tax paid. So once I have got my profit before tax, then now I can start. Sometimes in the question, by the way, also note, sometimes you may be actually given profit before tax. So meaning the examiner wants you to start from profit before tax. If you are given profit before tax, then there is no hassle of you starting from here. You just start from there. That if you are given profit before tax, then start from here and work backwards. Because majorly, this is to help us get the profit before tax when we are not given. But if the examiner gives directly profit before tax, then start it from there and move downwards. So profit before tax was how much?
$13.52.
Yeah, 1352.
1352.
Mwalimu.
Yeah.
This is Brian. Just a concern.
Yes.
You said in self-assessment, it's possible that when you're doing your self-assessment as a business, you can underestimate your tax liability.
Yes.
Which means there's also a possibility you can overestimate the same.
Yes, yes, yes.
So you will subtract in that case.
Yes, yes. If we open with the current, so if you overestimate, it means you overpaid KRA. Now KRA owes you. You get that?
Oh, okay.
Now you add it back. It's like you are reversing an extra expense. Now here you are recognizing the expense you never recognized because you underassessed yourself. Correct?
What if you paid? Can it be carried forward to the coming year?
Of course, now that is why the payment will be different. Of course, KRA nowadays does not refund. It tells you to use it. But remember, in our books, that expense we never recognized it. Correct? We have to recognize it. If we overpaid, it means we over recognized the expense. We need to reverse. The concept of payment is different. We need to reverse it and show it in the books. And then now, whether KRA is going to refund us or not, as will show KRA owes us. Correct? It's like the concept of prepayments and accruals.
So in this case, you're just recording the transaction.
Yes, because we never recorded it. Now it's like we assessed ourselves.
Okay.
So when KRA now gives us the final figure, we realize we assessed ourselves.
Excuse me, just on the same thing, Mwalimu, if I am getting you right, is if we had overpaid our tax, that will go in the prepayments.
Yes, if we had, it will now be like a prepayment, which we should do what? Less from here. Correct? 400 minus 100 instead of adding it.
Okay, thank you.
Mwalimu, just a concern. There's the tax paid that was shown in the cash book. Where did it go? The 100,000.
It is probably the one now because we are underassessed ourselves. Correct? Remember us, we said in the direct method, in the indirect method, we don't worry too much about the cash because in the indirect method, you are not using the cash book now directly unless told. But but when you link it, you realize probably it's the one you have now paid in the current year. KRA now tells you you did not pay us enough money. You underassessed yourself. You get that? Probably is the one you have paid in the current year. But then you realize, okay, then I never even recognized it. I now need to recognize it. Okay? Because when you look at the note, it tells you that note 1. Good. Then you are supposed to add the following things. And these ones, I want to deal with them together. But I'm going to go into detailing. Add back depreciation. Add back loss on disposal of assets. And less profit on disposal. These are not cash items. These are non-cash items. But majorly, this one you can pick them from the statements or from the. Now here, the good thing in the question, we were given the asset schedule. We were given the asset schedule, which shows the movement here. Fixed cost asset schedule. And then we also we sold a building in the year. So let's first check on the fixed asset schedule. So you had plant, you acquired buildings, total. See, there are 4730 acquired, probably acquisitions of 4730, probably were on credit, which could include payment to suppliers and payables, because we were not given its link directory of cash paid. So it could have been we acquired, but on credit. You get that? Acquisitions of plant for 730, but on credit, because we were not given directly. But now when we come here, under accumulated depreciations, charge for the year, depreciation charge for the year, 650 and 1500. So total depreciation charge for the year is going to be 2150. That we started with accumulated depreciation of the year of 3,500. We did depreciation for the year of 650. We closed with accumulated depreciation of 4150. Started with this here, and this is disposals. Of course, when you dispose an asset, you less its accumulated depreciation. So depreciation for the year in total were these two, for this plant and for this building. So in total, we had total depreciation of 2150. Okay. But again, when I will be looking at the second question, probably we're going to detail on how the T accounts for assets, especially when you are not given those figures. How could you get them? It's 2150. Add back loss on disposal of assets. So there's a building we disposed in the year. Let's check here if there was any note, and if not, you check it on the asset schedule now. Let's check here. We have a building we disposed in the period. Cash from sale of building. We disposed the building. We sold the building for 970. But remember, by the time you are selling the building, we want to know what was its value by the time we were selling the building. So let's go back here. So in the year, we disposed the building which had a cost. So this is the cost, and this is the accumulated depreciation. So we had a building. We started with buildings of 15 million. We sold buildings that had a cost of 5 million. So we remained with buildings of 10 million. So the building that was sold had an original cost of 5 million, but it also had accumulated depreciation of 4,500. Because under disposals, you also see that accumulated depreciation of 4,500 is being deducted. So by the time we were selling the building, what was its remaining value? How do you get the remaining value? Yes?
Mwalimu, I apologize, but I think I'm lost.
Where?
I think you have lost me somewhere. We are talking about the value of the building, and then now the accumulated depreciation. I think that is where you have lost me. I kindly request for you to go back. Kindly.
Okay. Okay.
Yes.
So this is how
you.
I think. Let me do this maybe today. Then even the remaining minutes only, we may not be able to finish the question, but I think let me do this. So that, because I was to do it in the other question, but I'll do this here. Naturally, when this is how we have the cost account, usually cost account of our business, cost of assets. Cost of assets, we have been doing previously. Cost of assets, we have been doing questions that have in the trial balance something like this: motor vehicle at cost, motor vehicle provision for depreciation. Correct? So it means a company will usually maintain how many accounts when they want for an asset? 2. Its cost account and its accumulated depreciation account. Correct? From our previous.
Yes, Mwalimu.
classes. Now, based on that, then we come here and say, this cost of assets we have here, how does it come about? You usually start the year with opening balance because they are assets. Opening balance will usually be there. Any additions in the year, additions of assets, you purchase assets, will usually go in there. Any costs of disposed asset will usually go to that side. If you revalue assets in the year, revaluation of assets will usually go there. Any cost of disposed asset will go there. Then at the end of now the year, you say balance carried down. And that, when you balance that, should be able to give you the two sides balancing. So the balance carried down should actually be like a balancing figure to balance the account, to find the closing balance at the end of the year. And we all know how we get closing balances. Then the accumulated depreciation account of an asset accumulated depreciation, which is the provision for depreciation, will usually have opening balance here, brought forward there. Then any depreciation charge, depreciation for the year, will usually be there. Then accumulated depreciation, when an asset is disposed from the business, we remove its cost from the business. We also remove its accumulated depreciation. It's no longer with us. Accumulated depreciation of disposed asset. There. Then we find what we call closing balance carried down for accumulated depreciation, which in then together with this one. So this one will now be balance brought down, which will go to the trial balance. And this one will also be the one that will go now to the trial balance when we close the books. So you'll have balance brought down, which will also go to the trial balance. So that is where when you go to the trial balance, you'll see the asset cost account has a debit balance here, while the accumulated, this balance will usually be a credit balance, the accumulated or provision for depreciation, based on what we did here. For example, you'll see that motor vehicle at cost, or cost is there debit, but motor vehicle provision is a credit. So those are now the closing balances probably, or at the start of the year or closing, that goes to the trial balance. Now, that is what the examiner has given. He has given those accounts, but he has given them in a tabular format. Probably that is where I lost you, and that's why I said I'll do this. So let's assume this is now the fixed asset schedule, and he has given plant or building. Let me deal with building. So for building, he has said at the start of the year, we had building opening balance of 15. Up to there, we are together.
Yes, Mwalimu. Kindly proceed.
Okay. Why is my... $15 million. Now, the examiner tells us during the year, there was no any additions in building. So additions in building were how much? 0. And we are not given any revaluation in the year of assets. Then he tells us now, you know, the lower part now, he tells us there was disposal of assets. The under building, under the cost part, you know, the first part is the cost, the second part is the accumulated depreciation. So it tells us there was a building that was sold that had an original cost of how much?
5,000.
5,000. So that building will be here.
5 million.
5 million or 5,000. It's okay still. Any cost of disposed asset. When you do that, what will be your balancing figure carried down?
That is 10 million.
10 million. It's what will close our account, and our account will balance at 15 million. At 15 million. So balance brought down probably in this will say 10 million. So that is the cost account. And that is why you see now the cost account is told, cost account at 31st December 2021 for building is how much?
10 million.
Good. Let's go to the accumulated depreciation side, correct?
Yes.
Opening balance was how much? 6,000. Opening balance was 6 million. Then we are told charge for the year under building here. Depreciations for the year were how much? For building?
That is 1 million.
1,500.
Yes.
Yeah, so I'm working with, of course, raised figures in my head. So 1.5. Then did we dispose a building in the year? And what was its disposed value? What was its accumulated depreciation by the time we were disposing it? So by the time we were disposing this building, it had a value of how much? Sorry, accumulated depreciation of how much? Disposals in the year? 4,000? 4,500. You see, under the disposal cost, the 5,000 was its cost of disposed building. Then now here will be accumulated depreciation of disposed building. So accumulated depreciation of the disposed asset will be 4,500. So balance the account and find the balance.
So closing balance will be 3 million. 3,000, I mean. Yes.
So 7,575. So
yeah,
closing here will be 3 million.
3,000.
Which becomes, yes, it's okay, 3,000, 3 million, no worry. So, and that is what is given here. So first you have been able to understand this with the examiner, the way he presented this information.
Yes, Mwalimu, I've understood. Thank you for taking us through that process.
Yeah, I was to go through this actually in the next question because that's where it was most applicable. But let me now finish because in the statement of cash flow, you need to know these accounts. So now let's come back here. So in the year we disposed a building that had a cost, we have seen a cost of, we disposed the building, a building that had a cost of how much? 10 million? Not 10 million, 5 million, sorry. And by the time we were disposing, at time of disposal, it also had accumulated depreciation.
4,500.
Of 4,500. So it will give us what was the value of the vehicle at point of depreciation. Value of the building, not vehicle. At time of disposal.
500.
Yeah, done.
500. Up to there, we are good. Then
Yes, Mwalimu.
this building, we disposed it. In our cash book, we can see there was cash we received from sale of a building. How much?
97.
What does that mean now? When you dispose the building,
we got a profit.
Good. You dispose the building at a cost at cash of 970. So that means we generated a profit on disposal of the building of how much?
470.
470, which is the 970 minus the 500, giving us 470. That is what we will be looking at here. See, when I was saying add back loss on disposal of assets, I did not see any. Less profit on disposal. So profit on disposal is going to be how much? 407?
470.
But now let's assume here, let me finish this because once you understand this, I'll have a finalized part. On the 4 minutes remaining, I want to note something. Now, most businesses maintain their accounts using this method where they have the cost account differently and the accumulated depreciation and the accumulated depreciation provision or provision for provision separately. But other businesses can have one account, the carrying account. Other businesses can combine the two accounts. And you may need to deal with this also in the exam, in a statement of cash flow. Can combine the two accounts into one, where now they call it the net book value account or the carrying amount. Carrying amount account. You see, when you have that, then they will be assuming that for them, they will only be recording things net off. So they will usually say opening net book value. So this is the carrying account, carrying amount, or net book value account. Opening net book value, then add additions of assets, additions or purchase of assets. Any revaluations on the asset in the year. Then when now we dispose the asset, we assume net book value of disposed asset. Then any depreciation charge in the year. Then we'll now have what we call closing net book value. So in this account, if I was to combine, this is what I could have done. Kapewa number, omba pole pole. So can we continue? Opening net book value. We come here and assume the asset, when we started the year, the buildings had a cost of 15 million. They had accumulated depreciation of 4,500. So by the time we were starting the year, what was the remaining value of buildings, the net value of buildings? $15 million minus 4,500, sorry, minus 6,000, sorry. We are looking here and here, the opening balance and this opening balance, we net them. So 15 million minus 6 million, because we opened with buildings that have cost of 15 million, but again, they had accumulated depreciation of 6 million. So what do you get there?
9 million.
9 million.
9 million.
Good, so 9 million. Then you check additions in the year. Any addition in the year in the building, we did not have any addition, 0. Any revaluation in the year was 0. Then we come here, net book value of disposed asset in the year. What was the net book value of disposed assets in the year?
Was it the 500?
500, because the remaining value of the asset that was disposed, value of the building at time of disposal is usually the net book value. Because you know anything, net book value is anything net of cost and accumulated depreciation. So 500. What was the depreciation charge in the year for buildings? Depreciation for the year, 1,500. Then you say now, close now, let's close this account and find the closing net book value. So what will be the closing net book value to balance this account?
7,000.
7 million.
So this, it is this minus this. Also, it's 7 million. Okay. So this is now what you should get again if you do the closing cost and closing accumulated depreciation. Closing cost was 10,000, correct? This one.
Yes.
The closing provision for depreciation was how much?
3,000 or 3 million.
So what was the closing net book value of buildings in total? 7 million. You know, sometimes, you know, it's good to be honest in detail. When I was to teach, you know, non-current assets up to revaluations, change in depreciation rates, that is almost a week we take in accounting, which we understand, you know, and that is where whenever you understand, and that's where the other week I said, sometimes when we teach your concepts, you get there are things that are in the syllabus which need prior topics, which sometimes are not well covered again, the way they are supposed to be covered in your, so we focus on the easier parts for the purpose of the other financial statements. Okay? Because now non-current assets are topic on its own and it's in depth. But now because we are doing cash flow, that is where it's arising and giving us problems. But now it has given me a good building ground for what I could have done in the next question. So what we do, I want you to go and just check, like now I've given directory here. You see, we have already, I'm doing the direct method and we are almost somewhere there, profit on disposal. I want you to go and check the way I've given this inventory, receivables, payables, accruals. You only check, compare. This is usually the easiest part because these ones, you just compare. So I'll pick up from there because you are supposed to prepare and we see now whether it's going to actually reconcile what we did in the direct and what we'll be doing in the indirect. So this is where now those things of change in receivables will come about. As someone now had asked, comparing, for example, closing and opening for 50 and 300, 475 and 500, accrued wages, closing and opening, closing stock, stock at the start, stock at the end. Those are the things that are here. You just compare and actually bring the change the way I've given there. Less increase, add decrease. So I'll pick up from there. So in our next class, we'll be able to complete that and be able to illustrate some concept of formulas also here using the other question now. Good. You see, if I could have started in detail.
So, Mwalimu.
Okay. My email is open. My email for KSL. Yes.
That one, I'm not getting you quickly.
No, but you've never asked anyone. Anything I don't answer there.
Sometimes I wanted to get you quick. That's why I'm requesting for that one, because I forget even the questions immediately I read them. So it's easier to get you on phone. Kindly.
You send over email there. I'll give you my contacts over email. You get in touch over email. You want to fix me
kindly, sir.
Because
I want to meet you because this thing is troublesome.
Anyway, so but you understand, guys. The reason sometimes I also say, if I could have started with these very difficult concepts, you people could have also started losing hope very early. So I'm insisting, get the right, whatever we've done, whatever we are doing now is just for purpose of, the optional. Whatever we've done previously, the easier concepts, I'm sure we have already covered. Other than theoretical, you just need to read the theory concepts. Quantitatively, we have covered most of the items you could get in a compulsory question. So I don't want you to start bringing in phobia at this moment. Okay? Haya, join the other class.
Asante mwalimu.
Haya, karibu.
Asante mwalimu.
Thank you, mwalimu.